The third quarter earnings season over in the US looks to be essentially complete, but by and large of late, people don't really seem to care that much about earnings. All they care about is the fears of a potential burst bubble in the AI space. Well, things are settling down a little bit, and therefore it's worthwhile appreciating exactly what has happened over the course of the past month and a bit to see exactly how earnings season shapes us up for the back end of the year and the beginning of 2026. So let's look into Q3 earnings, try and see what the lessons are and what it means for some of the different sectors and the US stock market as a whole. So first and foremost, we can take a look at the big picture. And this is the big picture, right? Essentially, what happens in terms of earnings growth should have a direct correlation to US stocks. This is the forward 12-month earnings per share metric over in the US, tagged on to the S&P 500, right? And so what you can see here is that by and large, as long as we see earnings continue to rise and grow, then that should form the basis of stock markets to do the same. Now, sometimes you'll see the market outperform earnings. That's when you see a price to earnings ratio on the rise, which is one of the reasons why people think that we are due a correction, because we're seeing stretched valuations. And sometimes you see it slow down and therefore price to earnings ratio weakens. So notably, we're of course within a period of expansion. It does point towards upside in terms of stocks over the near term. Nonetheless, it also, as you can see here, does signal exactly how far things have run and the fact that some element of profit taking or cooling down in the pace of gains for the S&P 500 would probably make sense. You can't keep seeing that runaway success of the S&P 500 outstripping the growth of earnings. Nonetheless, if we look at how earnings season has shaped up, revenues particularly impressive here. You can see here for the third quarter, 8.4% has not exactly been locked in, but I think we've seen 95% of the S&P 500 having reported now. So that is significantly higher than anything we've seen for a few years now. And the growth in revenues is really impressive, considering many didn't really think that was going to come right now. In terms of the breakdown on the sector by sector basis, you can see by and large, if you compare where things were in terms of expectations coming into earnings season, which is the bottom line, the 30th September line, compared to how things have shaped up, you can see aside from essentially just materials, we've seen outperformance across every single sector in the US market. So that signals that it's not just a tech story, it's not just an AI story. We are actually seeing a resurgence in terms of revenue growth and a boom for the US economy from that perspective. Now, top of the pile, you can see here is information technology, but then we have the likes of healthcare, communication services, that also has some of the other big tech companies in it. Financials up 9.4% in revenues, and the average 8.4 for the S&P 500. Then let's look at things on the earnings perspective. Things are even better on this front. So markets had expected 7.9 for the S&P 500 as a whole. We've gained over 13% in terms of earnings per share over the course of this period. In terms of the big boomers, you can see the financials that we've seen incredible profitability here. Expected 11.5, up 23.5. IT, again, very strong, 28.4 from 20.9. So those tech names do continue to lead the way. The bottom end of it, you can see here, in actual fact, weakness in terms of communication services, in particular, energy, consumer staples. But certainly there's some really big outperformers on the top end of this. And if you're looking at earnings per share growth and you're relating it to that initial chart that I showed you in terms of we need to continue to grow that earnings per share figure, well, this is the forward 12-month earning per share figure. So if we're seeing much stronger periods in this year, then what happens in the year ahead? How do we expect things to shape up? Well, that's going to improve as well. So certainly things from an earnings perspective, very strong. From a revenues perspective, very strong. The breakdown in terms of Mag 7 versus the rest can be seen here. So essentially the Mag 7 up 18.4% in terms of earnings growth. But we expect that, right? And markets, by and large, price in this rapid pace of growth when it comes to earnings on those particularly big growth names. But the rest of the market, I think, is really impressive. 11.9% growth for the other 493 stocks within the S&P 500. That was expected to be 5.9. So essentially double the growth rate expected in terms of earnings for the rest of the market. This isn't just a case of a handful of names growing and the rest not. This appears to be the case of outperformance across the board, essentially. Again, we're looking at that metric and looking at it from a wider perspective. And this is a really interesting one from my viewpoint. And that's because there had been this perception that what we were going to see was Mag 7 growth tailing off this year, and the growth of earnings for the rest of the market, so the 493, starting to rise. But that figure in terms of when it was going to rise kept getting pushed back. And I'd seen not so long ago that this chart essentially seeing earnings growth tailing off, and then at some point in the mid part of next year, that's when we see earnings growth start to pick up again. And remember, if we're looking in terms of the 12-month outlook from that first chart, if we see the outlook for earnings over the next 12 months improve significantly, then again, it picks up that line in a notable manner. If you look at that Q3 figure, that is really strong this time around in terms of the 493 in particular. And then when we look at the, say, Mag 7 names, we not only have seen a little bit of a tailing off in terms of growth rate, but we now see a picking up of that growth as we move into 2026, alongside the pickup in terms of the rest of the 493. Markets predict a tough Q4 when it comes to the 493 stocks. But by and large, that almost creates an easy win when it comes to a base case scenario that can be outperformed against. Certainly, we've seen a bumper rise in terms of earnings for pretty much the entire market, quite frankly. And you can see that here, right, in terms of the percentage of each of these sectors that have beat estimates or come below estimates or in line. Overwhelmingly, stocks are beating estimates. You can see consumer staples in particular, 93% for healthcare, 93% for IT, financials 89%. Yes, you've got a handful on the bottom end of this spectrum, notably communication services, and we can get onto that. But certainly there's a significant amount of outperformance across both big tech, but also the rest of the market. And it points towards relative health for US stocks. One thing that's always worth bearing in mind for traders is the fact that generally when a company underperforms versus expectations, they get hit a lot harder than the benefit they get from outperforming. And in part, that's because there's a perception that companies will guide you in a direction of a figure that they know that they can beat. They don't want to actually guide you in the direction of the exact number they're going to hit. So companies are almost finessing the numbers to be able to try and beat them. That's why if they don't manage to beat it and they underperform, then you see them hit hard. And when they beat it, it's like, yeah, well, you've done it the last 5 occasions, for example. So it's not necessarily as much of a surprise. Again, bringing it back to this chart, this is really key. Remember, earnings are a key driver of market direction. As long as you have the perception that earnings growth is going to continue apace, then that provides the basis for strength for stock markets. Of course, where things start to turn over, when it's talking about like recessions and collapses or pandemics, that's a period of time where you see earnings growth coming off and you see the stock market coming off as a result. But generally, we're in a very consistent trend since that pandemic low. Now, in terms of the charts, this time around, I just wanted to look at things from a sort of different perspective. And let's just jump onto, I just want to go full screen here. Let's jump onto this website, which is FinViz, which I think is a great website. And they've got a number of different tools. But one thing is you can look at groupings of the US market and essentially chart the different sectors. So I just wanted to sort of eyeball exactly how some of these sectors are shaping up over the course of this period. So remember, earnings season, as we had it on those charts, it was sort of 30th of September. So the past sort of couple of months, essentially, is when earnings have really been coming into play. So essentially, basic materials, you can see this pullback that we've seen at the moment. Yes, we could see a sort of double bottom formation. But yeah, some question marks. You'd want to see a break up through that neckline to make things sort of look a little bit more positive. Communication services has essentially seen that. So you can see this sort of pullback. It's almost like a double bottom, a W sort of shape. We're coming into the neckline. So this consolidation phase, it looks like, will soon be over. And we just continue on that bullish vein that had been leading into it. Consumer cyclicals, certainly we've seen that deeper pullback. We're trying to push into this once again, and certainly if we see the data improving in terms of the US economics, then maybe think this is a good buying opportunity. But certainly this is, because it's cyclical by nature, you're talking about something that does well during a strong point within the business cycle. The possibility of a rate cut from the Fed, maybe that's going to help things along. But really, we want to see some strong data. We're trading against a backdrop of sort of weaker jobs data, which is why we're expecting the Fed to take some actions over the near term. Consumer defensive, these have really been sort of trailing off over the second half of this year. So doesn't necessarily look in great shape right now if you're looking to get onto a trend. In actual fact, energy stocks doing relatively well here. You can see here rallying up into this sort of area of resistance of late, but certainly has been gradually regaining ground. Financials, a bit of a pullback in towards support. So again, this is similar to what we saw in terms of communication services, but we haven't seen that pop quite yet in terms of the financials. Healthcare has been a runaway success in no small part thanks to Eli Lilly, but certainly this is a really impressive chart, and the pullback that we've been seeing recently hasn't really shown up, most notably because this is perceived to be a defensive stock. In terms of industrials, this is a bit of a worrying one. I mean, we've ultimately sort of rallied, we've moved into more of a consolidation phase, and now we've broken down through support. So this is a little bit more of a concerning one. Doesn't necessarily scream bullish continuation right now. Real estate as well, that looks like it's sort of topping out. Yeah, not necessarily the area that looks particularly impressive at the moment. Tech, you can see, it's been hit hard. In particular, it's regaining some ground, but certainly it's some way off that prior high at the moment. So this remains sort of the key concern for markets. Then utilities, again, it's a defensive play. It has been pulling off alongside markets, but generally holding up relatively well, sort of consolidating akin to the moves we saw in August. Let's just look in terms of technology in particular and just try and see. Let's go on to some of the biggest companies within this and see exactly how things are shaping up, because the fact of the matter is not all stocks are made equal. So Apple, you can still see, remains on the front foot. You can see this consolidation and pullback ultimately leading towards another push higher. AMD, we're seeing a much sharper pullback, but it's coming back towards this sort of trendline support. So with the gap closing, there is a possibility we see the bulls coming back into play soon enough. ASML, again, sort of a bit toppy, but we haven't necessarily broken through key support. That looks quite similar to the kind of formation we're actually seeing in the S&P itself. Broadcom, we saw a nice big move higher on Monday. So trying to follow that up, but certainly, we've seen this pullback. It more looks like the sort of consolidation phase. And now we're sort of seeing that uptrend potentially kick into play. Salesforce in the doldrums, doesn't necessarily look great, quite frankly. Cisco, we have got an uptrend. We've seen a bit of a pullback, but it got pretty extended in the first place, right? So this just looks like a healthy move within a wider context. Microsoft has been suffering quite heavily here, and this is going to be a major drag on the index. You can see here, as it says there, sort of double top formation. So a wider pullback coming into play here. Does that provide a buying opportunity? Certainly for a stock like that, that's really going to be in the limelight. Nvidia has been pulling back, coming into an area of support here, sort of your 180 mark, and breaking a little bit below that off the news that Meta's potentially going to be utilizing the AI chips from Google rather than Nvidia. But yeah, this is going to be a key one, of course, biggest company in the world. So do we see this current pullback as a buying opportunity? Yeah, it's a difficult one. I mean, look, it's seen such a strong run up. I I think it's probably one to be playing over the short term and looking out for those sort of intraday charting patterns for that. Oracle getting absolutely smashed. Palantir, that sort of dropped out of the trend. That also is a warning sign, bearing in mind that's one of the stocks that Michael Berry has been trying to hit hard. But then there's been plenty of people that have tried to short Palantir over the years. SAP, again, not looking great. Shopify, seen this pretty sharp pullback, but it's come into this zone of support. That looks an interesting one. And then we've got this sort of trend line coming into play for Taiwan Semiconductors. So some interesting ones there. In terms of, let's just jump onto the S&P 500 as a whole. Now, what we can see here is that this pullback at the moment has come into support, sort of 65.50. It did move briefly below, but now we've seen this jump upwards. And crucially, if we break up through your swing high here, then it starts to look a bit different, 67.70. But we haven't quite yet. And that is a bit of a concern. I mean, look, for me, I think ultimately you need to be told by a chart exactly what's happening. At the moment, we have got the warning sign, which came in the form of a break through that support level. Now we've rallied up into the 76.4 fib, tagged it 1, 2, 3 occasions, or 4 occasions, and now starting to weaken a bit. So bit of a warning sign, quite frankly. But I do think a lot of the fear is probably likely to be left behind us soon enough. And so I wouldn't be surprised to see us bottoming out around these levels. I'm aware of the risk that is posed by that AI trade at the moment. But, I guess the question mark is, why would the bubble pop right now? Is it because people have become aware of the concerns around some of the valuations? Or do we wait until the growth rate of some of these companies comes off in a meaningful manner? That remains to be seen. But certainly at the moment, we have got this wider trend of lower highs and lower lows. And that's why a breakthrough 67.70 certainly gives me much more confidence that the bulls are going to be on the front foot. I hope that's been useful. Like I said, I think by and large, this earnings season has been a very good one, not only for the big tech, but also for much of the rest of the S&P 500. I've been through a handful of the big tech stocks to see exactly how some of the big decliners have been shaping up. But it's worthwhile noting that, the idea that the AI bubble is going to pop, it may for some, others are going to make plenty of money off this AI trade. And so when you look back in many years to come, you might say, oh, in actual fact, beyond that fear around the AI bubble popping, some companies have managed to get themselves in a position where they're making huge amounts of money off it. Others, maybe they invest a lot of money and they ultimately lose out. So that provides the basis for potential volatility ahead. Whether that happens now or not remains to be seen. But certainly from an earnings perspective, when markets come back to that core theme of what's earnings growth looking like and how does that drive sentiment for the S&P 500, I would say it continues to look very strong as we see Q3 earnings season draw to an end and enter December, which hopefully should see a nice Santa rally ahead. That's all for today. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Make sure to like, subscribe, and follow for more. Thanks a lot.